If you're watching national news to decide when to buy a home in California, you are looking at the wrong map. You have seen the headlines everywhere. Inventory is skyrocketing, price cuts are sweeping the nation, or the crash is finally here. If you live in Austin, Texas, or parts of Florida, that advice might actually be true. But if you are trying to buy a home in Los Angeles, Orange County, or the Bay Area, following that national playbook is dangerous. California is an economic island. While the rest of the country might be cooling down, our market is playing by a completely different set of rules. The reality here is tight inventory, sticky prices, and fierce competition. If you sit on the sidelines waiting for the national crash to hit the Golden State, you won't just miss the bottom, you will get priced out entirely. In this video, I am going to walk you through the 3 specific California anomalies that keep our prices high. And more importantly, I'm going to show you the exact financial strategy, including a loan program most people don't know exists, that allows you to manufacture equity in a market that feels impossible. The golden handcuffs, Prop 13. First, we have to address the elephant in the room. Why isn't the crash happening here? National pundits claim high interest rates will force people to sell. But that logic fails in California because of 2 words, Proposition 13. This is the single biggest differentiator between California and the rest of the United States. In most states like Texas or New Jersey, as home values go up, property taxes rise with them. It becomes expensive to hold onto a big family home for 30 years, which naturally forces inventory onto the market. But here, Prop 13 locks in a homeowner's tax basis. We have seniors living in multi-million-dollar homes paying taxes as if the home is still worth $100,000. These longtime owners have what I call golden handcuffs. They don't want to sell because doing so would trigger a massive tax reset on their next purchase. This creates a permanent artificial housing shortage that national data never accounts for. National data looks at interest rates and assumes people must sell. California data looks at tax rates and knows people will stay. That is why inventory remains historically low here, regardless of what the Federal Reserve does. Manufacturing equity, renovation, and ADUs. So if inventory is tight and move-in ready homes are commanding massive premiums, how do you actually win? You have to stop competing for the finished product and start creating it. In California, because the land value is so high, ugly houses are actually gold mines. The smartest entry point into this market right now is the renovation loan. Too many buyers think they need to buy a house and then save up cash for 5 years to fix it. That is the slow way. We use loan programs like the Fannie Mae Homestyle, Choice Renovation, or the FHA 203K. These programs allow you to buy a dated 1950s bungalow with pink tiles and old carpet and finance the renovation costs directly into your 30-year fixed mortgage. You buy the house for $800,000, you finance $100,000 in renovations, and suddenly you have a home worth $1.2 million. You are manufacturing equity instantly rather than paying a flipper for it. But there is a level 2 to this strategy that is specific to our state. California law, specifically SB 9, is aggressively encouraging density. This means you can use those same renovation funds to build an ADU, an accessory dwelling unit, in your backyard. This is the ultimate affordability hack. You aren't just building a guest house, you are building a rental property. We can actually use the potential future rental income from that ADU to help you qualify for the loan right now. It offsets your monthly payment, making the most expensive state in the country significantly more affordable. The fire zone nightmare. Now, before you go out and find a fixer-upper, there is one final critical hurdle that national lenders constantly miss. If you don't know about this, it can kill your deal 3 days before closing. It's the fire and insurance trap. Over the last few years, major insurers like State Farm and Allstate have paused or severely restricted new policies in California due to wildfire risk. Here is the nightmare scenario. You go to a big national bank or an online lender. They look at your credit and income and give you a pre-approval. You find a dream home in the hills or canyons, you write an offer, and you enter escrow. Then, at the very end, the lender asks for proof of insurance. That is when you find out the home is in a high fire severity zone and is uninsurable by standard carriers. The deal collapses, and you are at risk of losing your deposit. You cannot treat insurance as an afterthought in California. As a local lender, we check the fire maps on day 1. We know exactly which pockets of the state are difficult to insure and which carriers are still writing policies in those areas. Do not let a lender from Ohio walk you into a deal that is uninsurable. Conclusion: California is different. Whether it's navigating Prop 19 tax transfers, leveraging ADU laws for income, or just finding a policy that covers wildfires, you cannot use a national map for a California road trip. Don't let the headlines scare you out of building wealth here. You just need the right team who understands this state. Whether you want to identify the pockets of value right now, run the numbers on a renovation loan, or just ensure you aren't walking into an uninsurable trap, let's talk. I have opened up my calendar for one-on-one strategy calls to help you build your roadmap. Click the link in the description below to book a time directly with me, and let's get you into a home in the Golden State.